Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with David Dziekanski, who's the CEO and CIO of Quantify, and also the portfolio manager of the stacked Bitcoin and Gold ETF. David, great to have you on the show.
Thank you for having us. Appreciate being here.
Absolutely. So, David, I got to start by asking you about the election and the reaction we saw in some of the markets. It was interesting to see that gold sold off after Trump won decisively. On the other hand, Bitcoin went through the roof. Why do you think there's been such a divergence between those two assets? And do you think it's going to continue?
Yeah, it's funny surrounding the election, you saw a lot of talk about Bitcoin or gold, like which you should be purchasing as a hedge against currency debasement. But as you noted, the divergence between the two post-election has been absolutely massive. Bitcoin has traded much more in the camp of an inflation hedge with correlation to the Qs and broader equity markets, whereas gold has traded much more in line with a traditional defensive hedge with much higher correlation to, for example, treasury bonds. Both gold and treasury bonds have taken a huge hit since the election. And I think that really ties the divergence between Bitcoin and gold over that period is the expectation of higher debt to GDP in a Trump world versus a Kamala world. And so the world is repricing assets based on that expectation of potentially higher inflation in the future.
And you obviously manage an ETF that holds both gold and Bitcoin, David. What's the thesis behind holding both of these assets?
Yeah, absolutely. And again, we are Quantify Funds. The ETF is the STKD Bitcoin and Gold ETF, ticker BTGD. Both Bitcoin and gold are a store of value, a way to access a scarcity asset. Gold has historically been a store of value for a very long time. And a lot of people believe Bitcoin to be the digital version of gold. Obviously, you can see they don't trade in lockstep, but both are scarcity assets that don't have high value of creation of the underlying assets each year. Gold's replacement value is about 1.75% a year. It mines at a rate of about 1.75% a year, whereas post-halving, Bitcoin mines at about 0.86 basis points, so less than 1%. And so then you have to ask yourself, at what pace will developed nations around the world print their own currencies? And will it be over 2%? So we looked at this as a way to prepackage two different scarcity assets into one vehicle and also maximize the ability to rebalance between the two, as you've seen in this divergence that we've experienced since the election.
So, David, your fund is known as what's known as a stacked ETF or a portable alpha ETF. Can you explain what differentiates that type of ETF versus a traditional leveraged ETF?
Absolutely. A portable alpha is a strategy that's been used in the institutional world for decades. It's the idea of stacking two different assets on top of each other and getting leverage from a vehicle that has the ability to harvest some value from rebalancing between those two different assets in that stack. So the non-perfect correlation between Bitcoin and gold in the STKD Bitcoin and Gold ETF allows us to rebalance between the two, which smooths out a little bit of the volatility of owning the two independently on their own. Versus traditional leverage ETFs, there is no ability to rebalance between assets because it's just the carbon copy of the same underlying initial investment. And that makes it a lot more path dependent over time. And what we mean by path dependency is, if you hold a leverage ETF for 12 months, you can't determine what your return will be if you just look at the price at the beginning and the end. It's going to be dependent on the path between those two. And while stacking the two together gives you the ability to remove some of that path dependency, and as we like to say, leverage for the long run, these are leverage ETFs that you can feel comfortable holding for a longer period.
And how does a BTGD and other portable alpha ETFs work in a portfolio? What do you do with the extra cash that's created in the portfolio?
Yeah, it's more so like what don't you have to remove in your portfolio in order to incorporate some of these alternatives, whether it's the hedge fund space or Bitcoin and gold, currency debasements, or treasuries, finding assets that can diversify your portfolio. The institutional world almost always runs with some level of leverage on their portfolio. They find an optimal mix of assets and then apply an appropriate amount of leverage ratio to that. So these tools allow individuals, RIAs, any sort of allocators to also have that efficiency of leverage on a portfolio level basis. And we are accessing that leverage through the futures markets. So you're getting as close to as perfect a cost of leverage as you can in the entire marketplace, especially if you're an advisor trying to do this across a model portfolio. It's really hard to get consistent leverage across a client book. And this gives you that level of consistency.
Fantastic. Well, we're going to have to leave it there. David, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Sumi, thank you so much. It's been a pleasure.